What's up, you guys? I hope you all had a really good weekend. Last week, I was pretty sick with COVID and my voice was thrashed, so I didn't really make any videos, but I was taking a lot of trades. I did actually close out the calls that I had on Tesla. I posted this back on January 12th on X. I'm going to go over why I ended up closing this out for a $35,000 loss, why I did end up entering Tesla calls for 220. I'm still in those. And we're going to go over where I see Tesla going. It's the biggest loss I've taken probably in about a year and a half. At the end of the day, you guys have to remember too, I'm a portfolio manager. While the name of the company and the Discord and everything is traders helping traders, I feel that there's this unrealistic expectation in the market that people have to where your portfolio needs to be one or two trades. They're constant snipers waiting for the absolute best entry at all times. And it's like when you really look at big money managers, that's not how it looks. It can't look that way just because of liquidity reasons. So instead, what I focus heavily on teaching within the academy is the trifecta of number one, the mechanics of good trading. So building an edge, which is technical analysis. I have 10 to 15 different scripts that are all profitable. But just because you have a profitable trading script or a profitable trading bot does not mean that you're going to be a profitable trader. That's where the second part comes in, which is building your own custom risk profile and risk strategy. I kind of shit talk college a lot. And I don't think that college is really needed for a lot of people, but the one thing that they teach you in investment banking is risk profile and how to determine risk and build your own risk profile based on probabilities and thinking like a quant trader. Quanting basically is taking data, whatever it is, and trying to predict the future based off of data points. So I'm a quant trader. I do look at chart patterns, but mainly I'm running strategies that are very pinpoint entry and exit requirements to take past data and see if we can predict that pattern again in the future. This is why I have such little attachment to my trades. Number one, I've been doing this for nearly 9 years, so you have to be dead inside at this point if you've been doing this as long as I have. And number two, after you've triggered probably about 100,000 trades at this point in my career, you don't feel the same as the first couple of times that you've triggered a couple of your trades. And then the third thing that you need is adherence to the risk profile and plan. So the actual ability to fucking stick to the thing that we're trying to build here. And this is why it's so hard for many traders and investors, because the same is for investing. You still have to have a proper risk profile depending upon your time horizon for your investment, what your income looks like outside of the market, time to retirement, etc., etc. And then you actually have to stick to that while having some sort of edge in the market to find undervalued companies. So I ended up closing out this position specifically. Now, this position started with $50,000, and that was a profit that we ended up making back in December from the calls. So number one, we're already up, which is good. From a risk management standpoint, this is already not a risk off position, but we're already playing with house money, which can, number one, just allow me to be a little bit more aggressive with my position. Or number two, it could just allow me to not take a loss overall because we carried that profit over. So I said, Tesla, it's been a while since I took a loss like this. Shit happens. Every winning strategy has a drawdown and has failures. To hide from it is worthless. Instead, learn to build proper risk profiles so you'll never be able to lose it all at once. Allocation of capital in this trade is very small relative to the fund, just one of many. It's Friday, so we reposition, and this is how things play out. I'll have a video update later, which this is the video update now, a couple of days later. But basically, the reason that I ended up doing this, and this is a screenshot from the private Discord, which you guys can get access to with the first link in the description for $5 a month. But the reason I closed this out is that my strike was so far out of the money, and I wanted to reposition what capital I had left in the trade into a better priced option. For those of you who are more advanced when it comes to trading, or if you really do want to learn about options, there's a phenomenal book called Options, Volatility, and Pricing, Advanced Strategies and Techniques by Sheldon Nattenberg. It is one of the best books when it comes to actually learning how to price out options. And this is why I don't just hold an option in perpetuity. I'm usually balancing it out by rolling every single Friday. So I said rolling these over to March 15th, 220 calls. From the start, we plan to allocate 50 grand towards this trade on Tesla for the next 90 days. Closing the further strike March calls and taking the 20,000 left, putting it into the March means that no more capital will be added to this position going further. Now, the reason that I did that is because that option is just a better moving option. There's more volume, which means that all of your Greeks are going to be much better. And overall, when people want those contracts, it's easier for you to get out of the trade since we always want to have liquidity. So now let's move into the actual chart for Tesla. So we had this bullish order block that was sitting here and we had a liquidity zone pushed right under it at about 227. Last week I was posting on X saying I had expected this to pull back down into this liquidity zone, but that I thought we were going to tag a ton of people out, probably do a stop loss hunt, and then rip our way back up to 240. I was not expecting the pull all the way back down to 212 so soon, but you can see that we have this bullish order block down here, and even though we haven't pulled all the way back to the middle to retest, the bulls are stepping in before earnings. So all of this liquidity, everybody who wanted to get in down here last time who couldn't, and I'm not talking about retail like you and me, I'm talking about hedge funds who specifically want positions at 210 to 195 are going to start filling their trades going into earnings. That's why we're seeing this bounce. And I do think that earnings we will probably push up past 260, and this is why I'm still in my March calls. Now, if this doesn't end up happening, guys, I'm not betting the farm. I know it seems like a very big position, but relative to net worth, to the fund, to the allocation of capital, just for options alone, it's very small. But learning how to actually understand risk and manage it appropriately is something that I'm going to be dedicating this next year to by building one of the best risk management courses that I'm going to be able to create through actual strategies and procedures. Hope this video helps, guys. If you want access to all my other trades that are free, you can go check them out on X or in our Discord community. And if you want access to all of my trading bots, there's over 50 of them coded by myself, as well as tons more. You guys can get access to all of that with the second link in the description. Thank you guys for all the support. I'll see you next time. Peace.